In this video, we are going to focus on and look at your deductible expenditure. In the process of determining the taxable income, certain expenses incurred are deducted from your income. If you are in the process of calculating a taxpayer's taxable income, you will have to know which amounts of the expenditure may be deducted, as a taxpayer would like to be able to deduct as much of their expenses as possible. If you look at the basic framework for determining your taxable income, you always start with your income, which consists of gross income and exempt income. Then less all of your possible deductions. This gives you your taxable income before any capital gains. Then you add any taxable capital gain made during your year of assessment, which ultimately gives you your taxable income. Deductions of a general nature need to fulfill the requirements set out in Section 11A, read with Section 23. This is referred to as your general deduction formula. Now, the first requirement is your positive test, and this is set out in Section 11A, the requirements for what may be deducted. Then, Section 23 stipulates what may not be deducted, and this will be your negative test. The general deduction formula can be broken up into different components. Now, the first component, which is the most important, is the carrying on of a trade. So, in other words, the taxpayer must carry on a trade before we can deduct anything. Now, although this definition is very wide, it does not include all forms of income-producing activities. Passive investment activities are not considered to be trading activities. For example, activities producing interest, dividends, annuities, and pensions are not included in the definition of trade. The next component will be your expenditure and losses. Now, deductible expenditure is not restricted to expenditure in cash, but also includes the outlay of amounts in a form other than cash. The next component is actually incurred. Expenditure that may be deducted includes both amounts paid and amounts for which the taxpayer has incurred a liability. In other words, a taxpayer may deduct expenses actually paid and amounts owing. The next one will be your year or period of assessment. For income tax purposes, the expenditure will be incurred and deductible during the current year of assessment, but remember, for accounting purposes, it might be dealt with as prepaid expenditure. Your next component. In terms of Section 11A, deductible expenditure is only restricted to expenses incurred in the production of income. And the very last component, not of a capital nature. Just as capital receipts are excluded from the definition of gross income, so too is capital expenditure prohibited by Section 11A. It's very important to understand that the tests to determine whether an amount from a gross income point of view is of a capital nature or not are different from those used to determine whether expenditure is of a capital or revenue nature. There are so many rules and regulations in tax legislation that these rules and regulations are often open for interpretation. That is why you will find so many court cases on various tax issues. Each component of the general deduction formula is also supported by various court cases. The following court cases are definitely not all the court cases used to support the requirements of the general deduction formula. However, they are definitely the most referred to court cases. The first requirement, carrying on any trade. De Beers Holdings. It was held that the absence of a profit does not necessarily exclude a transaction from being part of a taxpayer's trade. In the Burgers court case, it also states that the fact that there's no continuity or there's a lack of profit, motive or risk does not necessarily mean that a trade is not being carried on. However, in this court case, the taxpayer's burden of proof increases when one or the other element is not present. The next requirement, expenditure and losses. Now in Joffe and Company, to sum it up, it states that the word loss is sometimes used to signify a deprivation suffered by the loser, usually an involuntary deprivation, whereas expenditure usually means a voluntary payment of money. The next one, actually incurred. In Caltex Oil, it was stated that the taxpayer may have incurred a liability which is payable only after the end of the year of assessment, and this would still be deductible. In other words, expenditure actually incurred does not mean amounts that are due and payable. In Nasionale Persbeperk, it states that if a payment is conditional on the happening of an event, whether suspensive or resolutive, the expense is only actually incurred once the condition has been met. In Edgar's stores, before an expense can be deducted in terms of Section 11A, it must be unconditional. That is to say, the expense must not be contingent, the event must have taken place. The next one, in the production of income. In Port Elizabeth Electric Tramway, the so-called inevitable concomitant or the closely connected test was performed. Now, firstly, it's required that the purpose of the expenditure must be established. Next, it should be determined whether the task was necessary and whether an expected or foreseeable risk was attached to that task. Thus, it should be asked whether the expense is so closely connected with the income earned that it may be regarded as part of the cost of performing it. In Joffe, the compensation paid is disallowed as a deduction if the negligent action is not a necessary concomitant of the trading operations. In Sub Nigel Limited, Section 11A does not require that claimable expenditure must have produced income in the same year it was incurred. And then in the BP South Africa case, the principle that was established in the PE Electric Tramways case, that the purpose of the expenditure must be looked at to determine whether such expenditure produces income, is confirmed. And the last one, not of a capital nature. Now, it was said in Sub Nigel that it is impossible to give a definition of what is expenditure of a non-capital nature, which will act as a touchstone in deciding all possible cases. In new state areas, the expenditure is to be regarded as part of the cost of performing income earning operations, or as part of the cost of establishing or improving or adding to the income earning structure, the so-called operations versus structure test. The other tests used for assistance in deciding the matter were the fixed versus floating capital test, the test to establish whether there was any enduring benefit or permanent asset created by the expenditure. And the last one, Gen and Company, it was stated that one of the matters to be taken into consideration is the closeness of the connection of the expenditure to the income producing structure as against the closeness of the connection to the income earning operations. The courts have established certain tests or norms that are of assistance when determining the capital or revenue nature of a specific type or class of expenditure. The first one is, what is the true nature of the transaction? Now, the true nature is a matter of fact, and the purpose of the expenditure is an important factor. If it is incurred for the purpose of acquiring a capital asset for the business, it is capital expenditure, even if it is paid in annual installments. One of the matters to be taken into consideration is the closeness of the connection of the expenditure to the income producing structure as against to the closeness of the connection to the income earning operations. Another test the courts have developed is whether the expenditure was incurred in order to bring into existence an asset or advantage for the enduring benefit of the trade. Fixed or floating capital. When the capital employed in a business is frequently changing its form from money to goods and vice versa, and this is done for the purpose of making a profit, then the capital so employed is floating capital. The expenditure of a capital nature, the deduction of which is prohibited, is expenditure of a fixed capital nature. Then we have the once and for all expenditure. The opinion was expressed that capital expenditure is a thing that's going to be spent once and for all, while income expenditure is a thing that's going to recur every year. What is the nature of the business carried on? The nature of the business a taxpayer is engaged in may determine whether an expenditure or loss is deductible. And then lastly, it has also been held that there is no halfway house between capital and income. However, in a specific court case, the court sanctioned the apportionment of income between a capital and a non-capital element. The apportionment of expenditure between capital and revenue should therefore also be possible, but the matter is as yet not tested. In terms of Section 23, certain deductions are prohibited despite them sometimes complying with all the requirements for deduction under Section 11A. First one we are going to look at, taxpayer maintenance. This is your Section 23A. The cost incurred in maintaining the taxpayer, their family, or the establishment is not deductible. Any domestic or private expenses are prohibited as a deduction. That is Section 23B. Section 23C, recoverable expenditure. A loss or an expense is not deductible to the extent to which it's recoverable under a contract of insurance, a guarantee, security, or an indemnity. Section 23D, any tax and interest of penalty. In other words, any interest or penalties and even taxes payable are prohibited deductions. Section 23E, transfers to reserves. Income carried over to a reserve fund or capitalized in any way is not allowed as a deduction for tax purposes. Section 23F, expenses incurred in respect of income that are exempt from tax are not allowed as a deduction. And Section 23G, non-trade expenditure. Section 23G contains the so-called negative test of the general deduction formula that should be read with Section 11A to determine whether an expense may be deducted from income. It provides that to the extent that monies were not laid out or expended for purposes of trade, the expense is not deductible. Section 23H, interest that might have been made on a capital employed in trade, that is to say notional interest, is not deductible. Section 23I, an expenditure, loss or allowance is not deductible to the extent that the expenditure, loss or allowance is claimed as a deduction from a retirement fund lump sum benefit. Section 23K, expenses incurred by a labour broker or a personal service provider is prohibited as a deduction. Section 23L, an expense incurred in respect of the payment made for a restraint of trade is prohibited unless it qualifies for a deduction provided for in Section 11CA. Expenses, losses or allowances that relates to employment of or an office held by a person that derives remuneration is not prohibited as deductions. In terms of paragraph M, only the following expenses for salaried persons can be deducted: contributions to pension, provident or retirement annuity funds, legal expenses, wear and tear allowances, bad debts, doubtful debt allowances, an amount paid back by an employee on which they were taxed, restraint of trade payments, rent, repairs or expenses in connection with a dwelling house or domestic premises. Section 23O, unlawful activities. No deduction is allowed for fines, bribes, unlawful kickbacks or penalties due to unlawful activities.